This is problem 1 of the statement of cash flow assignments. I've gone ahead and entered in the changes in the balance sheet accounts here, and I've gone ahead and titled the income statement items. So let's just go through and record our income statement. So we would have $290,000 of sales. That would have caused accounts receivable to go up. And then we could solve for cash collected from customers. We don't have an allowance account in this particular problem, so the only thing causing accounts receivable to go down would be cash collections, $294,500. And so we'd have that coming in here. And writing a little description, that's cash coming in from customers. So want to make a little note for ourselves. So if we formally write out the statement of cash flows, we would know the $294,500 is coming from customers. Cost of goods sold, the $144,000. And that's going to cause inventory to go down. And then we can solve for purchases of inventory. That would be $150,000. And the related account for that would be the accounts payable. So when we buy goods, accounts payable goes up, and accounts payable and inventory both go up. Then we can solve for the cash paid to suppliers of inventory from accounts payable. That's going to be $153,300. I'll make that. So if I make this A, I'll make this B. So A, and then $153,300. B, pay to suppliers of inventory. Okay, salary expense was $92,000. And then I look to see what's a related account over here, and we have salaries payable. Then we can solve for the cash paid for salaries. That would be C. Cash paid for salaries would be $89,000. Writing a little description, salaries. Depreciation expense was $8,870, and that increases accumulated depreciation, and we're going to stop there for now. We can see there's more to it, but we don't know much more than that at this stage. Utilities expense, $6,100. Utilities payable, you can see is the related account, and then we can solve for cash paid for utilities, $6,400. Transaction D. So $6,400 cash paid for utilities. Interest expense on the income statement is $1,500. And then related account is interest payable. Then we can solve for, like all payables, it goes down because cash is paid, $2,400. So cash paid for interest. I'm going to go ahead and jump to income tax expense. And that is $10,000. And the related account is income tax payable. Then we can solve for taxes paid, cash paid for income tax to be $5,000. Cash paid for taxes. Okay, now let's go back and do the loss. So the loss, we have to look at, well, what would they have sold over here to have a loss? Could it be the note receivable? But we can also see equipment went down. It's likely it's the loss on the sale of equipment. So, you know, we need to kind of figure out what that journal entry would have been. Change colors here. So we would have had a loss. So Sorry about that. Come in and erase this. So recognize our debit to the loss. Let's make this number 9, and it's $900. So let's write it out in journal form though. So there would have been a loss of $900. Equipment would have been credited. So equipment would have been credited $54,000. Likewise, we would have done something to accumulated depreciation. So how much was it credited? Excuse me, debited. So I add these two together, and I'm going to get $42,000. So they gave up equipment with these two accounts. Cash would have come in, and the difference was a gain or loss. So I'm going to add up the debit, subtract that from the credit. Cash must have been $11,100. Okay, and that would be an investing activity. So I'm going to kind of draw my line. Those were all operating activities. Let's kind of have some spots for financing. And then we'll have investing here. And I see I did not overly allow myself enough space for this. So 11,000, actually that should be in green. 11,100, we'll make this number 9, and that was the sale of equipment. Okay, and as we go along, I'm going to have to come back in and erase because I didn't position that very well. But there would be, under cash, a debit of 11,100 as an investing activity for this. Okay, other things on the income statement, we would zero out the revenue and expense accounts. Sorry, that's actually supposed to be a 0. Zeros are kind of looking like 6s, aren't they? Okay, so I zero out revenue and expenses. The difference is net income. That's going to be $26,630. So I put that as an increase to retained earnings. Okay, so let's just keep looking. So now we're going to go, we can actually see retained earnings must have had another transaction. So if it did, what causes retained earnings to go down? Dividends. So what do we ready for? G? So dividends are a financing activity, so I'm going to put it here. So dividends paid. And I do have this solution in a PDF copy so you can see a nicer, cleaner version of this. So a debit to retained earnings, credit cash, financing activity, 1,180 for dividends paid. Common stock went up 24,380. Make that entry age. That's also a financing activity. Cash would have come in 24,380 for issuing common stock. Okay, so we have a debit to cash financing and a credit to common stock for that transaction. Okay, I'm going to stop and erase this entry here real quick. Okay, that frees up a little bit more space. So we just keep looking. Sorry, things kind of froze on me for a little bit. So we just kind of keep looking for more cash transactions. So these are in balance, that's in balance. Notes receivable went down. Well, why would notes receivable go down? Well, just like accounts receivable, it goes down because we collected on it. So this can be transaction I. So notes receivable went down. That's going to be an investing activity. So cash would have come in $15,000. Collection of note. And again, you can get a little nicer copy of this in the PDF version of solutions. Oh, I'm sorry, I made a mistake. I didn't get that 54,000 posted from before, so let's go ahead and do that. That was transaction 9, and then the 42,000 here. transaction 9. So we had a debit to the loss, debit accumulated depreciation, and debit cash 11,100, and then a credit to equipment on that one. Okay, then we just keep looking for more transactions. Land went up. Why would land go up? Because we buy it. Transaction J, it's a long-term asset, so that makes it an investing activity. So $15,000, purchase of land. Note payable went down, $25,000. Well, why does long-term debt go down? Long-term debt goes down because we paid it off, and that's a financing activity. $25,000. Payment of debt, and I would write a little note there, payment of debt. Okay, so let's look at what we've got. We have $294,500 coming in from customers, $153,300 paid to suppliers of inventory, $89,000 for salaries, $6,400 for utilities, $2,400 for interest, and $5,000 for taxes. So when I net those items up above, we have cash from operations, $38,400. This next section here, all of those are financing activities. So $24,380 from the sale of stock, $1,180 a dividend payment, and $25,000 a note payment. And then these three down here are all investing activities. Cash received from the sale of equipment, $11,100. Cash collected from a note receivable, $15,000. And then $15,000 paid for the collection, paid for land, the purchase of land. Okay, so if I take all my debits, subtract my credits, you're going to see you'll get this $47,700 change in cash. And when that happens, you know you're done. Then real quick, the indirect method. We start with net income, $25,000. So net income, $26,630. And then we add back anything that's not operating. That would be the loss of $900. So we start with net income, take out anything that's not an operating activity. So this loss on sale of equipment is an investing activity, so remove it. We also add back anything that's not a cash payment. So depreciation expense, add it back of $8,870. And then the rest of this is just accounting for the changes in current assets and current liabilities. So accounts receivable went down, that's on the credit side. So put it down here on the debit side. So increase in accounts receivable. Inventory went up, $6,000. That's a debit. Put it down here as a credit. Oop. Sorry about that. Did these two last arrows, I turned those around, didn't I? Must be getting a little tired. Sorry about that. Okay, so we have a decrease in accounts receivable and an increase in inventory. Okay, that's long-term, that's long-term, that's long-term, that's long-term. Accounts payable went down. It's a debit, so put it down here as a credit. Decrease accounts payable. Then we have salaries payable, an increase on the credit side, so put it over here as a debit, just the opposite, so increase salary payable. Utilities payable went down, that's on the debit, so put it over here as a credit to balance debits and credits. And interest payable, the same thing. Income taxes payable went up, that's on the credit side, so let's put it down here as a debit. And then note payable would be long-term. So we draw our line. I'm going to add up all of these 6 debits, subtract the 4 credits, and I will get cash from operations to be $38,400. Okay, and that agrees with the direct method. So we're in good shape. Okay, here is the solution to problem 2. I just wanted to go over what unique things, because these two problems have a lot of similarities, so no sense in another long lecture for me. But I do want to point out a couple of things. One is that there was both the purchase and a sale of equipment. So in the narrative, I first told you about the purchase. So you needed to record this from the very beginning. So the debit to equipment, the credit to cash for investing activity, you need to have made that debit and credit entry right up front. So, and the little description, purchased equipment. That had to be done in order for you to solve for this $31,000. So you would have known the change in the balance sheet. The account went down $16,000. You also know that we purchased $15,000. So when you get over here to the gain from selling equipment, you can see, I've got a credit of $900. When I add these two together, I can figure out, well, the account had to have been credited $31,000 during the accounting period. So I can figure that out. But anyhow, I had to do the purchase first. The other item that I wanted to point out is this other expense. When you do debit other expense and then you look over here for a related account, you won't find one. We can see, cost of goods sold and inventory, and then purchases of inventory and accounts payable. Whereas salary expense has salaries payable, depreciation expense has accumulated depreciation, and rent expense has prepaid rent. Income tax expense has income taxes payable, but other expenses does not have a current asset or a current liability that it's related to. So what that tells me is that it was paid from cash. So you're going to debit other expenses and you'll credit cash under the operating section. So again, if it doesn't have a related current asset or current liability, that tells you that they paid cash right away.